Sterlite Technologies recorded a strong March quarter. Revenues doubled, profits surged 47%. However, the company has lowered its margin expectations for FY20 to help us understand the factors at play in the quarter gone by and the year ahead. Group CFO Anupam Jindal joins us right now on the show. Anupam, good having you. Thanks much for joining in. Let's start off with the margin contraction. What explains, what are the factors at play here, and what can you tell us about how the numbers could look like in the year ahead?
So I think let's address the first issue of margin contraction in the Q4 as well as for full year. I think it's a mixed issue more than the margin issue. If you look at the margin was about 18%, 4.5% lower than last quarter. Out of 4.5%, I would say 3% is attributable to the higher mix of services business, which is relatively low margin at about 11% EBITDA. And about 1.5%, 150 basis point can be attributed to some of the price softening which we have seen in our products business. Now, going forward, as we continue to see more of service business coming in, I think that mix issue will continue, and we have always maintained that our EBITDA percentage is a factor or a derivative of the mix of products and services business. Having said that, the China thing, which is currently localized, there are certain ripple effect also, and we'll see that we are already operating at close to about $7.5 kind of pricing regime, and we are comfortable making margin of about 25-26% in our product business. So I think even if we see some price effect coming in some of those markets of Europe and some other markets, I think we also continue to work on our cost structure and our internal value-added products which we are developing through our investment in technology, and that will help us maintain our margin profile. So I think as a company, we have always seen these kind of things coming in, the pricing pressure or volume pressure every 3-4 years, 5 years cycle, and we have been able to come out more shining through these industry dynamics.
What about the specific pricing? Can you tell us whether the pricing in China is hurting some of the other markets, and if not now, can it hurt when your contracts come up for renegotiation?
So I won't be able to comment on the pricing scenario of China in particular, because that has been quite irrational at times, so we can't really say. But what I can say for sure is that whatever are the current pricing in China is really not sustainable from the supply point of view. Even if we see more supplies coming in, but those will be definitely at a higher cost than the current pricing environment. Now, how long it will sustain is difficult to say given the China economy and the local dynamics. But I would say that we continue to look at our own internal benchmarks in terms of cost, in terms of realization, the kind of margin we want to make, the way we want to upgrade and enhance our products offering so that we continue to have both premium in our pricing, in our customer quality, and our products offering. That helps us have a higher blend of realization, and that I think will continue, because this is very difficult to sort of predict what kind of pricing scenario will be there. But as I said, that it's not really sustainable purely from the cost economics perspective. A lot of these players who are out there in China, we don't think that they have that kind of cost economics to make money in this.
So are you then therefore saying that there will be no further impact on margins? This 18-17% or 18-19% that you've seen, is that the base case for margins?
Yeah, I think some of that has, we have seen some softening. We used to operate at upper end of $8. Currently, we are at close to $7.5, $7. So I think that's a very good industry move or balancing out. We can't really remain at those kind of levels where it becomes so attractive that people start coming in this industry. So that kind of cleaning up is important in this industry, and we as an integrated player continue to get some mileage out of it, because we have got access to large customers, good quality customers who want this kind of offerings which we are giving.
I actually wanted to ask about whether the margin impact will be felt or no, but I'll come to that in a bit. Maybe the other positive factor to look at, Anupam, was the return on capital employed, which you've ended FY19 with at the highest ever levels. What happens next, and I mean, there are a lot of conversation about the working capital stress that you might go through as well. How do you balance both of these things out?
See, ROC is already at 34% for the full year of 19, and that's a great number. Last year we delivered 30%. Our endeavor will always be to increase or maintain that number, but as a stated objective, all our businesses, we continue to look at 25% as a threshold, because you will always find when we incubate some business or when we get into the new offerings, new customer geography, you will find some investment will be required which will offset this 34%. But as I said, that 25% is something which we would like to maintain even going forward for 2 to 3 year kind of outlook. I won't say that 34% will move up further, because I mean, we have the two clear direction. One is that increase absolute EBITDA and maintain a 24%, 25% ROC. And within that spectrum, whatever growth we can deliver, that will continue to deliver.
I want to talk about your growth. The FY20 guidance that you've given, 100 million, net about 700 crores. With this 568 crores of the current year, implies that your growth rates will come off from 50, 60, 70% that you would have clocked in. You've now come down, or you will come down to about 23%. Is that a new normal?
See, we have given this guidance in July 2017, just about 2 years back. And we currently stick to that, and we are happy that in last 2 years we have been able to stick to what we sort of gave direction, and even for 20 we look very confident. In terms of the number you said, 23-25% kind of growth, see, this is directional, and while we have given much higher growth in the past, whether that can be maintained or would be, down to 25%, though it's a very good number, but I would say that we need to look at it from long-term perspective. This is a static number we have given for FY20. We don't generally give annual guidance, but this was a 3-year kind of a number we gave out to set that confidence in the minds of our investors and stakeholders. But we continue to work on creating sustainable shareholder value through our business across the various verticals which we are developing. So this is something which we'll definitely try to achieve and try to deliver beyond that. But as a stated number, I don't want to move that, and create, who knows that we may deliver more. But as a number, I would say, and I don't want to carry a baggage on her, shoulder that we give some higher number and then we start justifying or defending those kind of numbers. But as I see internally, we creating a great value. How it will translate into numbers over the long term will only time will tell. But I think we are doing something great internally in terms of investing in technology and talent, and through that we are trying to get new geography, newer customers, newer solutions, and really transforming the entire sort of business model we have.
The stock has corrected though, Anupam, and I think the market might be worried about what could happen to the margins going ahead. With the current prices on both the businesses, your margins are at about 18%. If indeed the pressures are off, would you believe that the margins are bottoming out? And if you can also give us some sense about the fundraising plans. Is it an enabling resolution? When will you do it? What's the quantum?
See, first, if I address that margin question, that, it would be difficult to say that margins are bottoming out, because this is a dynamic situation. What we are confident of, maintaining a certain profitability. Now, when I say that, it is on year-on-year basis, because quarter-on-quarter, neither we believe in giving, those kind of guidance or justification, nor we want to control those kind of numbers. Let it flow as it comes, but largely we remain confident that margin profile will continue, and what we see as a blended profile, we are already talking about it. Now, second part, which was about fundraising. So, look, this is an enabling resolution which we need to take, because it needs to go to the shareholders. We have been taking this kind of resolution for last 5 years. We have not used that. We take it as a window, because while we don't have any active plan for fundraising, but we continue to look at opportunities for growth through organic and inorganic. and at no point we want to be constrained by not having shareholders' approval. So that's the overall thought. It's just to have that option open. It's a dynamic business scenario. Definitely what we will do will be for the growth of the business, and at appropriate time, if we need to do or consider something, we'll definitely look at that.